Trapped. Mortgage holders feel home loan pain. Today, we're going to take a look into this. We're also going to look at a question from one of our viewers talking about the national property clock and expected timeframes between property cycles. Let's have a look. And starting off on the top, we're seeing trapped. Mortgage holders feel home loan pain. Many borrowers and mortgage holders are unable to switch to another lender because of rising rates, falling prices, and mandatory borrower stress tests, which mean they don't qualify for another loan. We're starting to see a little bit more of that, particularly as interest rates have risen. The banks previously doing stress tests on lower assessment rates. So previously they were looking at about a 5.5% buffer in terms of the actual rate that the banks use. Now they're sitting in around that 6.5%. So we have seen a shift in that, which is meaning that those borrowers that were able to secure a loan previously now are finding that their borrowing power has reduced. Now, this is causing massive concern to many borrowers that are wanting to find a cheaper home loan rate to reduce ongoing costs as rising inflation really puts pressure on family budgets. Now, 8 lenders, including CommBank, Westpac, Macquarie, have actually recently cut their fixed rate, which when we saw last week's announcement, the Reserve Bank increased the cash rate for a 4th consecutive row by another 0.5%. So that means over 4 months, the official cash rate went from 0.1% to 1.85%. Now, the massive thing we've seen here is it took 4 years for the Reserve Bank to move the cash rate from 1.75% in 2016 to 0.1% in November 2020. We've seen this 4-year reversal happen in 4 months. So there's been massive increases in a very short period of time. We also need to remember in the loans that were written from November 2020 till April 2022, the bank stress tests was based on a 5.5% interest rate. So they calculated people's affordability based on that. So they effectively added 2.5% on the current rates at the time. As we get closer, 2.5% on that 0.1 gets us to 2.6. We're actually finding that borrowers is got to actually not qualify for loans that they were previously provided, given that the cash rate is higher than what they were stress test for. So definitely interesting times. We're seeing rising variable loans, which is mainly determined by the cash rate. We've seen falling fixed rate loans, which is mainly based on the decline in bond yields. Encouraging, and we're definitely getting more questions from borrowers considering switching to a fixed rate or whether they should stay variable. And borrowers are starting to decide and make that decision on whether they should go variable and continue with the rate rises, or if it's better to fix in, and maybe the fixed rates, they'll be better off when they look at it in the future, or they might be worse off when they look at it, depending on where the official cash rate goes. Now, a lot of borrowers might find that they're actually stuck, particularly with values of properties going down, assessments changing, and being able to find a different rate and get that down definitely makes a huge difference there. And that's where we're talking about a few people are finding that they're in a position where they're stuck. They can't actually move because they've had values of their properties go down, or they're still highly leveraged. So I had a client recently that they were looking to refinance a property in Varsity Lakes, and effectively when they set that loan up about 6 months ago, they didn't have a 20% deposit. So refinancing would mean they have to pay lenders mortgage insurance again. So in that situation where they're finding rates are going up, the fixed rate their bank was offering was a lot higher. They tried to renegotiate with their lender. It just didn't make sense to refinance to a different bank because the costs of mortgage insurance would mitigate any gains that they'd see from the refinance. So definitely something that is starting to come out. We're seeing that a little bit. We're seeing borrowers are discovering that they're trapped with their existing lender because of falling values of their property, rising costs on their loans, and the regulator, APRA, mandating a 3% serviceability buffer, which they use to assess with borrowers with coping with interest rate rises. Now, it's previously that rate buffer was 2.5% that the banks were using. APRA's changed that to 3%. And that all plays a part in understanding your ability to borrow and service a loan and how that might have potentially diminished. Many lenders are not coming to the party on reducing loans for existing borrowers, so they're actually getting trapped. There's better rates with other lenders out there, but a lot of the times they can't qualify with them, as we talked about, for a number of reasons, mainly increased borrowing requirements and assessments and lower valuations. Now, I would argue the assessment rate changes has only really affected those that were really at the top limit of their borrowing capability. Those that were comfortable in their lending criteria, they're not going to really find that that new assessment rate is going to have a huge difference. So we're probably more talking about the marginal borrowers, those borrowers that really put every cent in the dollar to get in the market to begin with, and now finding that they no longer qualify. With property values, well, yes, if you've bought with a 20% deposit previously or less than a 20% deposit, and if the area you're in, the values have gone down, that can be an issue. Interestingly, we're still having some success with our home refinances and some of the lenders we're working with in getting valuations to stack up. I had a client only recently where we were refinancing their loan from their another bank, and we'd done a few valuations with a few different banks, and the valuation between one bank and another bank was substantially different. We had a valuation of $1,220,000 with one lender, and another lender gave us $1,350,000. So if we took the first lender's valuation, yes, they'd be locked in, they'd be trapped into their mortgage, and they'd be completely devastated because that 1.2 million valuation meant that they had 15 grand in mortgage insurance, but that 1.35 million valuation meant that they could refinance, get equity out, and still be in a far better position, reducing about 1% off their interest rate. So don't be caught up in the headlines. We've got to remember there's still options and avenues out there. There is going to be some borrowers that are going to be affected and trapped into their mortgage, but it is something that working with a mortgage broker like ourselves, we can look at and see what we can do to work around it. Now, the banks use these buffers to really determine whether a borrower can meet their repayments even as interest rates rise. And we've seen that recently with all these rate rises definitely being an impact. And nationally, we've seen a decrease in home values is what their experts are predicting, 10%. They're saying 10% decrease in values by the end of the year nationally. And at the current rate of decline, it could even reach up to 15%. Now, keep that in mind, it's very broad, depending on where you are. Even suburb to suburb, that decline in value can change quite drastically. Depends on the sales in the area, what discounting is going on, and really certainly starting to move and see the cycle move into a more declining market, which is very normal part of the cycle. We know property goes through a peak, then it declines, it bottoms out. So it's a very normal part. We see Sydney, Lismore, Ballina, Coffs Harbour all starting to decline. We're seeing areas peak, such as Ipswich, Mildura, Brisbane, Albany, Canberra, Dubbo, Geelong. They're starting to peak, and other areas still in a rising market. Now, we do have a viewer's question we'll run through in a minute about that, but we'll just run through this. I guess a couple of things also to keep in mind is about 35% of borrowers have fixed rate loans or had taken up fixed rate loans previously, which before the pandemic sat at around 20%. So a lot of borrowers during the COVID, post-COVID property rush, we saw get fixed rates. Now, a quarter of these loans are actually ending their fixed terms, which they fixed in for 2 years. They're coming up, and a lot of them are with the big four banks. A lot of those are coming up July, December this year. So CommBank has 38% of borrowers that will be coming up off their fixed rates between July and June. We've seen that's about $53 billion worth of loans expected during this period. We're seeing Westpac with about 48 billion, same sort of thing. NAB, 30 billion, ANZ, same sort of deal there. So what we know is with people coming off their fixed rate, they're going to find that they're going to be in a bit of a rate shock. Rates are higher than what they fixed in on. Maybe they fixed in at 1.99%, and they're going to need to start looking at refinancing options. So that's where we can definitely come in and give assistance there. Keeping in mind, reducing costs on your mortgage can make a huge difference. You only need to look at if your fixed rate ends, you go to a 5.1% fixed rate, you're paying $726 per week. That's a lot of money to be paying, considering if you were to refinance, you can get that right down to about $578 per week at a 3.19% rate. And added to that is if you're comfortable to continue that extra payment, so continue to pay $726 per week, you'd actually pay the loan off 8 years, 9 months faster and not pay the bank $100,000 in interest. So you'd actually save 100 grand. So refinancing, getting a lower rate, and if you're able to maintain your repayments, will not only see you save money now, it'll see you pay off the loan faster. Now, if your budget or your family budget's quite tight and you need that extra $148 per week, well, there's no pressure to pay that down faster. It just gives you an example that paying the loan quicker will mean that you pay less interest to the bank. Now, we have seen CBA previously predict, and they've stayed pretty firm on this, that they believe the cash rate will peak at 2.6%. Currently, the cash rate is at 1.85%. So another sort of 0.6 to go. We've seen ANZ say that they're expecting the rates to peak at 0.35%. Now, both banks are predicting rates will go will peak and then come back down. So CommBank saying by the end of next year, in November, the cash rate will go from 2.6 to 2.1%. ANZ saying by November 2024, which then determines whether whether or not it makes sense to fix. If you think rates are going to peak like ANZ said, well, maybe fixing in makes more sense. If you think CommBank's prediction is more accurate, then potentially going variable over that shorter term makes more sense. That's where something like having a chat with a broker like ourselves, we can have a look at your situation and see which avenue makes sense based on your plans, what you're sort of thinking in terms of where the market's going, your concerns, and all that sort of stuff. Moving on to our viewer question, we had ask that the national property clock is interesting, which we covered in one of our videos previously. And he was saying he's a Brisbane lad looking to buy a second property. And what's a reasonable time frame for Brisbane to get past 3 o'clock on the national property clock? So let's have a look here. 3 o'clock is a declining market. As we can see, Brisbane currently in a peak state. We have started to see a lot of areas cooling down, so we might see this change. This is based on July, so we're still waiting for August as an addition. Look, I guess there's no exact time frame. Looking at property values in Sydney over the past 10 years, we can see really from 2011 upwards, Sydney peaked to 2015. So we can see it was in that rising market and recovery for a very long time, and then peaking in 2015, we can see maybe 12 months or 6 months by the looks of it, where it went through a declining market and then bottomed out and then started to recover again from March up until 16 to June 17, and then same thing started to decline and increase. I think the truth is, a lot of industry pundits out there will have you believe that the market's going to crash. It's going to stay like that forever. Once we start to see rates move back down, so rates are going to peak, and then when they start to go backwards, we might see consumer confidence come back in. Certainly over the next 12 months, we'd say with interest rate rising, we'll see that demand might be subdued. We might find that we'll stay in that declining market for a little bit there. So there's no exact time frame. We can see Brisbane over a similar time has had pretty steady, consistent growth. There was a little bit of a lull there. What we do know with the Brisbane market is it's still very affordable in compared to other capital cities like Sydney and Melbourne. We're still getting a high interstate migration. So trying to predict the time that would be in that 3 o'clock phase is going to be really difficult. Jaden did a video recently, you might have seen it, where he talked about the fact that trying to time the market is a really difficult one to get right. I think you'll only know in hindsight. And even timing the market is probably not the thing to keep in mind. It's all about the time you are in the market. So if you're planning to buy and you've got long-term plans and you can see yourself holding onto the property for the next 10, 20 years, as we saw in that example before, we can see that steady trajectory of growth. Here at Hunter Galloway, we're mortgage brokers. We're based in Australia. We deal with people Australia-wide. So if you're in Sydney, Melbourne, Brisbane, Adelaide, and you're looking for a great mortgage broker, we can help. We can help with purchases, refinances, investment properties, whatever it happens to be that you're after. hit us up at huntergalloway.com.au, call us on 1300 088 065. There's absolutely no cost for the service. We'd love to have a chat and see what we can do for you. Guys, thanks again. We'll speak to you again soon. Have a great day.